Welcome to The Growth Shift, the podcast where we unlock the psychological and strategic blueprints of predictable growth. If you've built a successful business, you know the truth. Your expertise is high value, but your time is finite. The question is, how do you sustain that success without sacrificing your most valuable asset? We believe that the next level of success requires a strategic pivot, a fundamental shift that moves beyond the old ways. In every episode, we dive into the critical turning points of industry leaders and uncover how they're leveraging AI not as a shortcut, but as the strategic force for their next growth shift. Today, we dive in with a leader who is defining the future of their industry. This episode is brought to you by Valentix, your strategic growth partner. At Valentix, we believe that trust and authentic relationships are the only true currency in high-value business. We challenge the status quo by building an AI-powered client acquisition engine that enhances your human connection, helping you move beyond the slow growth of referrals. Our AI-powered systems eliminate the grind, allowing you to break through the noise, automate tasks, and free up your time to focus on transformative client impact. If you're ready to build a predictable growth engine, learn more at valentix.io. Now let's dive into today's episode. Today on The Growth Shift, we're joined by Taylor Hess, the founder of Stonebridge Business Advisors. Taylor's career is a compelling study in financial acumen and strategic advocacy, spanning from a recovering financial advisor at Merrill Lynch to helping high net worth individuals navigate complex financial endeavors. Now, through Stonebridge, he exclusively represents lower middle market companies through the intricate process of exiting their businesses, fighting against the financial sharks, and ensuring fair value. His insights into M&A, strategic financial planning, and the practical application of AI in business offer a powerful blueprint for entrepreneurs navigating critical transitions. Taylor, welcome to The Growth Shift.
Thank you, David. Grateful to be here.
Oh, excited to have you on the show today. Now, Taylor, your journey began as a financial advisor at Merrill Lynch, then moved to helping high net worth individuals with these diverse financial endeavors. Tell us a little bit more about the journey that you went through and some of those highlights of your career along the way.
Absolutely. So started off out of school at E-Trade, where I kind of got my broker's licenses, and then I was recruited over to Merrill Lynch to help manage money for high net worth families by a top team in Atlanta. And that was just a phenomenal experience, getting to know folks with money, getting comfortable talking to people with money. And, I found kind of a common thread that most owned their own businesses. And as kind of that career evolved, it became kind of a timing thing where it was a bit of a divergence in my what I really wanted to do to help people, and in my actual ability to do that with the regulatory environment that I saw. And so that was kind of the big struggle that I started running into. And then, of course, that coincided right alongside with COVID. And that's when I decided that I kind of had a gut feeling that I needed to make a shift away from the retail wealth management side. And I didn't really know where to go because I had all these credentials that I spent so much time studying for and all these licenses that I had to decide whether I wanted to forfeit or not, which ultimately I'm glad that I decided to do that and found an off-ramp to kind of a firm that allowed me to pivot into something that would open up my horizons, which was a multifamily office in Atlanta, where I joined on as an analyst, and from there got involved in all sorts of different deals with folks that had upper high net worths. And we were doing all sorts of complex debt financing, equity raises, buying businesses, selling businesses, everything from developing real estate. I mean, it just spun all over the place. And so that's really where I cut my teeth on kind of the M&A stuff. And that's where I found my heart kind of really residing in that space, was the ability to kind of help control and make, I guess, a larger impact for folks that were looking to have large events in their lives. And fortunately, what enabled me to do that was the flexibility of that firm.
Incredible. And what you learned and what you experienced working for this family office, it sounds like it really paved the road for you moving forwards, but that never would have happened if you didn't leave the financial industry, of course. I mean, you mentioned that, you didn't leave your financial advisory role, you're still in the financial industry, but you mentioned that there were a lot of, regulations, maybe a lot of red tape that were perhaps confining you and operating the way that you wanted to be able to help people. Can you tell us a little bit more about that? I mean, what position were you in that you saw you weren't able to help the way that you ultimately wanted to?
Yeah. So good question. I was, working for Merrill Lynch, being owned by Bank of America, once they bought Merrill, they started instituting a lot of their own rules, which in my mind was kind of an inherent conflict of interest from the fiduciary standpoint, where, you'd have the bank telling you to sell certain products, bank products that not necessarily were, something I would recommend in just a normal circumstance. And so there was a lot of cases where I just kind of felt like, I wasn't free to truly help and recommend certain things that, I could stand behind. I know there's the compliance. I mean, it's no secret in the financial industry, the compliance is higher than anywhere else. And the oversight is just ungodly. So you can't really do what you used to be able to do in a lot of cases in terms of making recommendations and being able to, I guess, get ultra flexible and creative, which is kind of how my brain works. And so you're kind of confined to this little box of operating. It kind of feels like it felt too much like a commodity that I was, just like any other guy. And, I kind of saw the writing on the wall with, back in, I guess, 2018, 2019, where we started having these robo advisors and they were managing portfolios at a fraction of our cost. And it kind of became very clear that somebody could easily do that. And, my days were numbered as a financial advisor if I was going to continue in that space. So to kind of get ahead of the game and again, because the gut feeling just wasn't right, I didn't feel like I could make the largest impact in that space. I decided to kind of spread my wings and take a leap of faith into, a adjacent field, but I'm super, super glad that I did. I mean, it set the groundwork for where I've fortunately been able to get to today.
Well, absolutely. And for someone such as yourself, with a creative mind and wanting to think outside of the box and bring true strategies, valuable strategies to your clients there while working at Merrill Lynch, I can imagine being confined to that box or restrained to that box was not only confining, but I mean, with all the financial strategies and angles that you could go to ultimately be able to help people in the best way. I mean, you were operating within a small space that you weren't actually being able to operate to your capacity, right? So I imagine it must have been very limiting, not just for how you could help your clients, but how you yourself could grow, right? So you made that shift from the gut feeling, from what you saw coming. You moved into the family office. Sounds like you had a little bit more room to grow. You had some great impact that you were providing for your clients there. Why ultimately decide to leave the family office and start out with Stonebridge?
Well, I kind of went from two pretty wild extremes. One being, unbelievably regulated, to a very open architecture firm where the founder, who I've tremendous respect for, he kind of decided to branch off and start his own firm, and that's where it's a very small, multifamily office that we were handling basically the unique investments of these high net worth individuals. And what I loved about that is it gave me so much exposure to so many different industries, different aspects of finance, of partnerships, of running businesses, of working with banks and in real estate and all sorts of different areas. And we were a very lean team. And so we had, I guess, about 12 to 13 families that we were actively, not any given time actively. We were only active with maybe a couple of them on any initiative at any one given time. But with all these different families, there were so many different needs that would come up, and I would get pulled in so many different directions that ultimately, with me being the only analyst at the time, it became very, very difficult. I was stretched very thin, and I wasn't able to kind of hone my focus into one specific discipline. One day I'd be trying to raise debt. The next day I'd be trying to, put a proposal together for a large commercial real estate investment. And then the next day I'd be working on trying to sell a business or finding owners who wanted to sell their companies. I was very blessed that I had received an introduction to a company that is in the pool and spa space, and they sold stone and tile and things like that for pools. Again, right during COVID, so it was a phenomenal time to sell a company like that because all these home services companies were doing extremely well. And I basically ran, I guess, about 95% of that deal, of course, with the oversight of the partners. And that was really what gave me my first glimpse into this sell-side advisory space. And I noticed very, very clearly that there is a tremendous gap in representation between the lower segment of the lower middle market to the middle market and lower middle market. So you've got, I guess we can dive into this in a bit, but you've got kind of a gap between the business brokers who, I mean, I don't want to bash them, but a lot of times they're more or less glorified real estate agents, to be honest. But you've got the upper, I guess the segment above that is your M&A advisors and investment banks who typically won't look at a deal that's less than $20 million or so. So with that gap, you've got a tremendous need for people to get represented. And that's where this deal fell, was in that little window. And the clients, they had an offer in hand when we originally spoke with them from a potential buyer. We thought that they needed a lot more than that. And we ended up taking the deal out to market, and I led the initiative to that, which is really what opened my eyes, because what happened was that first offer that they had received would have netted them I'd say about $5 to $6 million after all was said and done, with the structuring and how it was all working. By the time that we got done with the deal and actually closed it, they cleared, let's say they cleared north of $15 million net of taxes after all was said and done. So it was a tremendous eye-opening experience that, there's effective representation that can be brought to these folks that otherwise would get totally worked over by some of these buyers who are very unscrupulous, and they prey on the business owners who are frankly not in this space. They're not in the business of transacting businesses. And that's really what opened my eyes, was you've got these financial, I call them financial sharks that, they come in and they smooth talk the owner and, oh, we've done this a million times. You can just send us over your information, and they seem like they're all on the up and up until you start peeling back the layers of the onion. And once you start really diving in, it's unfortunate just with the climate that we're in, but they do take significant advantage when they can, as you would imagine, large private equity and public companies may do. So I wanted to really kind of dive into representing those folks and fighting and punching back against the people that were trying to take advantage of the backbone of our country. So that's what really led me to kind of dive into the M&A advisory. So I kind of decided that we needed to kind of have an M&A division at that family office to start building out, which we started doing. But ultimately, I still was getting pulled in so many different places, and I wanted to really focus on helping out that owner who had a great asset, wanted to sell, wanted to go through the process, and needed the care and attention and total focus, undivided focus to represent and go through the process, because it is a lot of work and a very invasive process. So that was really what led me to determine that because of getting pulled so thin, I had another one of those gut feelings that I needed to just kind of plant my own flag and do it on my own. And so fortunately, with the help of some mentors and some trusted folks that believed in me, I decided to branch out and start up Stonebridge to exclusively help those companies that are kind of in that lower middle market segment of no man's land, I guess.
So from your time at Merrill Lynch, operating in an environment that was too rigid and there was too much red tape, too much restriction, you moved into an environment that then had maybe too much freedom, right? You were being pulled in so many different ways, but through that you started to be burned out and you realized there was one space you wanted to operate in. So coming back around to that narrow focus, but with a little bit more freedom to do things how you want and have the impact that you wanted to create by actually providing people with something they really needed, not something that, you were being told you should provide at the end of the day. So you found this gap, you identified the gap in the market of, business real estate brokers, we could call them, perhaps not serving clients properly, and you found a position you could fit in perfectly. And you founded Stonebridge. So, we understand conceptually what Stonebridge does and, the value that you provide, but what does that look like in practice? When you come in and you work with a client who is thinking about approaching the point where they want to sell their business, maybe they're looking to sell it to private equity or someone else. How do you come in and you actually help them get the worth and the value out of their business and make sure that, they're not perhaps just being taken advantage of by a large financial shark who's just in the game for themselves at the end of the day?
Yeah, absolutely. And to be clear, I consider a lot of the folks in my seat there's a lot of sharks that are willing to just look at a company and just list it and take a fee on the end and not put a whole lot of work into it and just kind of play the volume game and the numbers game. We don't do that here. We take a very holistic, big picture approach, and I like to call it a goals-based transaction advisory. And so we begin by really understanding the owner and understanding their wants, their needs, their desires. Do they really want to sell? Are they just having a tough time? Are they really ready to sell? And kind of peel back a lot of those psychological barriers that I tend to find with owners that are at some type of inflection point. And in terms of how it works in practice it is a very invasive deep dive on the front end of where are we? where do we want to go, what's feasible with where we're at right now, and then what do we need to do to accomplish that ultimate goal and objective. And so in a normal deal cycle, let's say somebody they're ready to go, and mentally they're ready to retire, hang up the cleats and call it a day. But their books we look at a couple things on the front end, and it doesn't seem like they're going to get the most value. Well, we'll do an assessment on the front end to make sure that there's no massive deal killers that we're going to encounter in a normal process. If we see some issues kind of on the front end, we'll identify those, make some recommendations, and maybe we revisit it once they've fixed some things. But again, in a normal case that everything's clean enough, they're ready to go, what we're doing is a full dive into the financials, the operations of the company. We're doing almost, you'll hear the term quality of earnings. We do almost a full quality of earnings in-house before taking a company to market. I want to know where all the bodies are buried. I want to know what all those, personal expenses that are run through the company are. I want to know, where, everything about the market, the business, the owner psychology, and really get to know people to formulate a plan that is most effective for them in terms of executing the deal. And so we'll collaborate on what type of buyers we'll be looking for. We'll collaborate on the marketing materials that we'll present to market with our kind of custom strategy for how we're going to approach the market, how we're going to position the company, and what we ultimately want. And then from, once the time, a lot of folks think, well, finding a buyer, that's all the work. And it's really not. That's really where a lot of the work begins, because you have to undergo an endeavor that makes getting a mortgage look like nothing. I mean, they go through your underwear drawer and then some when it comes to selling a business. And it's very taxing emotionally, trying to get all that stuff handled with a million people looking at your business, a lot of time in secret because you don't want your employees to know about it, and maintaining additional the ability to maintain operations throughout that process, knowing that there is a possibility that it may not work out. So it's a very difficult thing for an owner to undergo. It's extremely difficult to undergo by themselves. And so having representation who can kind of pull the emotion out of it, and also knows the landscape of how negotiations go, knows how to talk to banks, knows how to talk to private equity, knows what the, what the cracks in the foundation of a presentation to us from a buyer may be, and being able to identify that on the front end to make sure the whole process goes smooth. Because again, once you're in the process and they're actively looking at documents, you've got attorneys flipping documents back and forth, and you need somebody to kind of be the quarterback to make sure that the deal actually closes. The value of an M&A advisor is not in finding a buyer. It's in structuring a transaction that is most advantageous for the seller with the best possible terms at the best, obviously we want the best price, and then getting the deal across the finish line. That's the biggest thing is when you're asking people, what is your closing rate? That's a real statistic that, it's kind of a dirty secret in the business broker industry that the closing rate with business brokers who don't do all the work on the front end, slap some stuff together and post it online, wait for the phone to ring. Those closing rate is disturbingly low. And, they'll dress it up a number of different ways, but I like to partner with my clients to make sure that we're fully executing our plan to the best of our joint efforts ability. So hope that up.
You mentioned is the emotional aspect of this, right? Not just how emotionally taxing it can be going through the process of preparing to sell a business and, trying to keep it from your employees in a lot of situations, obviously for their own concerns and for the health of the business, but also the fact that, most business owners, founders who get to a point where they want to sell their business, many of them got there based off of grit, determination, passion, love for what they do. So then mixing in, of course, the process of going through selling the business emotionally, but also the emotional aspect of letting go of that and having it in the hands of somebody who may not serve their own clients or customer base the way that they would want them served. I imagine that comes into play significantly as well. So it sounds like you're not just going through a transaction, but you're really helping people through an entire process, almost from a holistic point of view.
Absolutely. And that's kind of where the financial advisor in me comes out, is kind of that fiduciary minded person to be in the corner with the owner who, I got a lot of education at Merrill and experience in becoming kind of a financial psychologist at times, and a therapist with people who, they may call right in the middle of a transaction and just, break down, and they just, I can't do this. It's, it's too much. And it's such a roller coaster with such highs and lows that you really need to be kind of that even keel person that, hey, it's okay. We've got this under control. Here's what usually happens. This is normal. This is part of the process. It's all going to be worth it in the end, and we're going to get through this together. And so a lot of that, I think the psychology and the emotional component of selling a company is really overlooked quite a bit because people want to just dive into the numbers. But I want to make sure that my client's ready to go. I want to make sure that they know what they're getting into, and make sure that they're going in eyes wide open, knowing that they have kind of me as a backstop, and a mediator and quarterback and just kind of the point person for the overall transaction. Yes, it's very holistic in nature for sure.
Yeah, needless to say, a few minutes ago you mentioned cracks in the foundation. Being able to find those for when a buyer might be looking at a business, and you want to fix those cracks so you can increase the value of that company that you're representing. In your experience, when looking at companies approaching that point of sale and acquisition, what do you think are some of the biggest cracks that are most common that decrease a company's potential value, where when fixed, they can have the greatest impact on a company's value?
I think the number one is going to be the financials. Financials. How clean are the books? Have you invested enough money to make sure they are clean? Or is your CPA just kind of a personalized version of H&R Block, or are they really going in and doing some tax planning? Who is running the books? Who is overseeing the financial function of the business? That's pretty much, I think, I would argue, if you ask anybody who has been around in this space, that's got to be the number one thing. And it can have the most profound impact on valuation. I'd say second to that, tough to say a second. I guess that the others kind of seem to fall into, buckets beneath that. But I think the mental readiness, a lot of times people think that they're ready, but when it really comes down to it, they haven't really thought about what they're going to do, after a transaction closes. They, maybe, the employees are not, the management team beneath them is not built up enough. That's usually a huge one, to where there's not another key individual to step into the shoes of the owner, and you don't have that knowledge transfer the way that you could if you had everything, fully optimized. So I'd say those are probably the biggest. If you have, an owner that, and this is a question I always ask prospective clients, an owner that's removed from the business to where it can run on its own is a far more saleable asset than one that is completely reliant on the owner. So the question I always ask is, what would happen to your company if you took a 1 month or a 3 month vacation, and you turned your phone off? You're going to, the Philippines and nobody's talking to you. What happens to the company? And that is a very telling test on the ability for the company to run without the owner. How
financials at the end of the day is what a business is built on and reliant on. But if it's founder led to the point where they can't step out of the business and can't operate without it, then of course a lot of the value of the business is tied to the owner, right? So if you remove the owner, then you're removing a huge chunk of value unless it can operate in that way.
Exactly. Yeah. And that's where there's a lot of discounting of businesses, because it's too risky for a buyer to come in and pay a premium on a business, even though the business may be printing money and growing and growing and growing. If it is, depending on the type of business, and I'm a bit unique in that I'm a generalist and I'll work on most industries, but typically if you don't have the ability to pull the owner out, you're going to get a significant discount on the business. Because the buyers they're buying future cash flow, future certainty of cash flow. Their investors are investing in returns and certainty of returns to the greatest extent possible. So a buyer is always thinking about that. And based on your buyer profile, whether it's a strategic, larger corporation, or a financial buyer like a private equity, or maybe even an individual, those are all going to be different approaches, and they're going to look at things a little bit different. You may have an individual who wants to buy a business, who maybe they want to get out of the corporate grind and they want to go buy an HVAC business. That's a pretty hot topic these days. Well, if they're going to step into the owner's shoes, it may not be that big of an issue, because if the owner's willing to help them get up to speed, then maybe they can just hop into that seat. Similarly with financial buyers or strategics, maybe they can plug somebody in. depending on the business, depending on the relationships, but at the end of the day, it's what is everything tied to? Is it all tied to the owner's name or the business? Who are the relationships with the suppliers, the customers, who's managing all of that stuff? And if it's everything going to the owner's cell phone, then there's a high probability that they're going to discount that pretty heavily, because once that guy's gone or gal's gone, what certainty do they have to maintain that same trajectory of growth that they're paying a premium for?
Taylor, the approach that you're taking with Stonebridge and what you do, you seem like an outlier in the M&A world. It seems like because you do things so differently and you provide so much value, people should be knocking down your door to come and work with you. But there are so many M&A firms out there. There's so many buyers. There's so many prospective sellers as well. When it comes to client acquisition, with the approach that you take and the amount of value that you provide, how are you approaching client acquisition today to generate the most success, not just for you, but in terms of the impact that you can provide to your clients?
Well, client acquisition, I'm very, very blessed and grateful that has not really been an issue for, since day one. Have a phenomenal network that, has some really trusted individuals that are willing to put their name on the line, which means a tremendous amount for me, to put my hat in the ring. And so as far as client acquisition goes for me, I like to kind of take a bit of a unique approach. Instead of just picking up the phone, since this is such a, when somebody sells a company, it's usually the first time and only time that they do it. And so to get a cold call or to try to, send a cold email, it's a pretty low probability that you're going to strike gold. It's those typically involve, at least the way I do that, is nurturing a relationship over a very long period of time. And when you're kind of brought in with that credibility already from a referral source, then you kind of bypass a lot of that stuff. And then you can discuss, the heart of the matter, and your credibility is somewhat assumed at that point. So I like to kind of look at this in a bit of a different lens, and understanding that there is this gap in offering. I like to approach the investment banks and build relationship with the investment banks that are doing deals above my threshold, that will turn their nose at a $20 million company and they have nowhere else to send it to, and they want somebody to run an active process and not just a passive kind of throw stuff against the wall, see what sticks process. So those folks, when they are referred over to me, the understanding is that I'm going to run a full scale process to actively reach out to people, actively market the business, actively work on it, and not just kind of sit back and turn them over to a buyer and attorneys and just let them all hash it out, which far too often happens. So as a result of that, in the lower middle market, kind of the lower scale that businesses become, really a lot of times the harder it is to actually run a full process on those, because a lot of times the financials are very messy. A lot of times the owner is extremely involved in the business. I guess just messy. The lower you go, typically the more messy it gets. So a lot of times, unfortunately, we're not able to help those folks with the process that we run, which is a painful thing to turn somebody away and say, I can't help. But it's not that I can't help. It's that, the economics have to be there, because there's so much work on the front end to run an actual process. A business has to be able to generate so much revenue to where I'm not taking such a large bite out of the apple to do the work that I need to do, that they, it ends up jeopardizing the deal or just their regular course of business. So there's got to be that match from a client profile criteria. And, we are flexible. We do kind of color outside the lines, and we're willing to take a look at some things that are outside of our norm. And so I will take a very creative approach to it. To give you an example, there was a landscaping company that I was fortunate to get introduced to last year, that the owner was just him, mowing lawns. He was running phenomenally tight routes. It was a great little business, but he didn't think he had anything to sell. He thought that, well, I just sell the trucks and, call it quits. Every business broker that he spoke with was saying, well, this is not going to sell. We're not going to be able to, it's going to be hard to find somebody to come in and run this thing. And we took an approach that was, let's just sell this as the value that it is, which is customer lists and some equipment, and just try to find some local company that's a little bit bigger to just cut a check for it, because it was a couple $100,000 for this total enterprise value, which normally I would never be able to run a process. But this was a very unique case where, if I can see an angle to help somebody and I can connect some dots and hold hands, through the process, through the attorneys, and kind of run a leaner process, I will. So I'm very open to that, but there's some criteria that have to be met. That's kind of an outlier. But generally speaking, revenues that are below 2 million, it's very tough to run an active process. And then, revenues that kind of eclipse, 20 or 30 million, that starts to get to where I want to refer those clients up to the larger investment banks to continue to build those relationships so they can send the stuff back down my way.
The approach that you have, I think, across the board is fantastic, just in terms of the value that you provide and the strategic positioning, right? Because at your time working in the multifamily office that you were at, you recognize the gap. And this is an excellent lesson for any coach, any consultant, any advisor who's trying to find the right place in the market. Taylor, you identified that gap, an underserved market that you knew had a problem and you could solve. So yes, you pursued it, but rather than trying to pursue it in a way that you were competing with larger firms and trying to get in front of them or falling behind them, you position yourself beside them, right? So that you can be an advantageous partner to them, but you can serve clients that they wouldn't otherwise. They'd be happy to hand them to you, and you can return the relationship reciprocally, right? You can hand off the larger clients up to them. So you're in your own lane, you're solving a problem that is out there and that is definite, but you're doing it in a way that puts you in a position where a lot of people wish they could be. So I think it's an excellent lesson in not just providing value and finding a gap, but the right positioning in the market beside not competitors, but potential partners and your investment banks as referral partners. I think it's an excellent position that you're in.
Yeah, I appreciate it. It's a lot of fun to look at, folks as, instead of competitors, potential folks in my network who I can help and they can help me, and we can have reciprocal relationships. And it's the reason people don't do an active full-scale process at this market is because it's harder and you make less money. And that's the truth. Unfortunately, that you can do a lot less work because the businesses are a lot cleaner when they get bigger and do a lot less work. And, your payouts are significantly greater. That's kind of that middle market, lower middle market space that I play beneath, but the competition is so great up there. I mean, why chase that when the folks who I see really need the help are beneath that, and I can kind of be the bulldog and be their advocate, and that's what I enjoy. It's kind of being able to help the people who really want and need the help, who are unfortunately overlooked because there's bigger dollar signs with other folks.
Absolutely. So Taylor, with what you do, you analyze and you handle a lot of data within businesses and with what you're doing internally. Today, data processing is taking longer than, often takes longer than ever, but with the right approach, it can become easier than ever as well. It's starting to incorporate AI, not just into data, but into operations, so that you can free up your time to really focus on serving your clients in the way that you're pursuing. Tell us a little bit more about how it is you're starting to think about AI and how it might start to play into your strategy to allow you to continue providing impact rather than focusing on maybe small minutia and mundane tasks of every day.
Yeah, absolutely. That's a great question, and that's the topic of the times right now, right? I feel wildly behind the times with AI, even though I am utilizing it quite extensively. It is very clear to me that if the business is not from here on forward built around AI rather than alongside AI or just using AI, if I don't do that, or if other firms don't do that, I believe that they're going to be in for some tough times. I'll tell you, I got slapped in the face with an example last year where I was arguing with an attorney about an agreement, and I had my attorney brought in to come and help argue against it. And after a couple back and forths, I noticed that it started feeling like AI, and I realized that I was arguing against a lawyer robot I was paying my attorney to help me argue against an AI lawyer. And that's where I was like, all right, it's here. It's time to really adopt this, and this is a very, very large law firm. So I know that it's happening all over the place. So in terms of how I'm using it now, again, I think it's underutilized, but as far as recording conversations so I can maintain, being present on those conversations, having them transcribed, getting summaries, and then uploading those into a database and kind of a master project that I can kind of use as my brain for that particular client. And I can, ask questions as if it's, its own chatbot about the company. Hey, what were margins like in 2022 and that sort of thing. So that's extremely helpful. And we're currently looking at, I've heard great things about Claude code for financial analysis and modeling, which I think would be a tremendous replacement. It's obviously a lot better than having to pay $120,000 salary to an analyst, and it sure beats sending the work overseas to a lot of these firms that, you're only paying, 20, $30 an hour, but you can obviously get a superior work product in a fraction of the time. And I mean, it's kind of a no-brainer. So finding ways to really capture that, but maintain the quality of the level of work that I do and kind of the level of attention that I think the deals need, that's really the challenge. And so the quality control and fighting my own instincts to want to do stuff myself, I think those are the biggest.
And for anyone out there, I mean, it's impossible to keep up with AI at the rate that it's growing. So I think everyone feels behind today, I've got to say. But the approach that you're taking, I think, is the most important place to start, right? Focusing on how can you just free up your time from heavy thinking in a lot of situations, not in terms of the critical thinking and making decisions for you, but just sifting through data and pulling out what it is that you really need so you can free up your time to really focus on your clients. Because at the end of the day, you're not going to have an AI going and interacting with someone to sell their business and fight for them to get the best deal, at least not yet. And I hope we don't get there, right? But, being able to really invest back into that human element, especially for such a personal business, personal transaction at the end of the day, right? Curious here, Taylor, with your experience in financial advising and the understanding of regulatory frameworks, when it comes to the use of AI with sensitive financial data, what do you think are some of the biggest risks for businesses starting to integrate AI into their core operations?
That's a really good question. And that's one that is very top of mind right now because, until I get the confirmation and the knowledge personally, and this is again kind of where I'm lacking, until I get that full confirmation that the security is there, that you're safe with what you upload, what you feed into the machine, I'm very cautious. Of course, then there's another side of me that says, well, we all know Equifax got hacked way back when. I'm sure our social security numbers are all floating around anyways. So it's kind of like proceed with caution, but proceed and don't just sit there and kind of wait. So I'd say I'd love to get kind of your answer on that because I know that you probably deal with that quite a bit in your business. And I think that's a very, very critical component of this is how safe is my data? Where is it going? Where does it live? Who all is seeing it? How could it squeak out somewhere else? And also being mindful of what you're putting in that you do need to protect and totally keep safe. So that's an active issue.
You're absolutely right, Taylor. Generally, to the audience, you shouldn't be feeding sensitive data into a generic AI or a platform, an open source platform like Claude, like ChatGPT, because that data is not secure and it's not protected. It can be done so in a way, but you have to create a secure environment. You have to take it offline, off of that main server, and build something out that's custom in order to make sure that you're not putting in anything that shouldn't be leaked out there. And it may not be necessarily directly leaked, but if it's not in a secure environment, that information can be accessed and shared by the AI to other people ultimately. So the information is being put out there, right? You cannot risk going against breaking compliance in this way. So a good place to start is to look for those AI platforms that have the highest level of security, SOC 2, SOC 2 compliance, HIPAA if you're in healthcare, right? Platforms like this, they're going to have those safe rails. They're going to have the levels of protection needed for you to be safe and at least have a little bit of security yourself, right? Have something to fall back onto if something goes wrong, because with their certifications and as long as you have insurance, right, things can actually be handled properly if anything does go wrong. Because exactly as you said, Taylor, Equifax was hacked, a number of years ago. So if things like that can happen then, they can happen today. You just have to make sure you're taking the right steps to put yourself in the best possible situation. The last thing you want to be doing is taking no action at all.
Absolutely.
Taylor, your story covers financial acumen, strategic advocacy, and a deep commitment to helping business owners navigate critical transitions. For the founders, the coaches, and the growth-minded listeners who are navigating their own growth shift, what's the single most important piece of advice that you would leave them with about strategic adaptation and preparing for the next chapter of their business?
I think that the biggest one is a open mind and active curiosity and adoption of AI and understanding that it is here to stay. It is not going anywhere. I mean, we've all had kind of a taste of the candy and we know how powerful it is. And as you mentioned, it's getting smarter and smarter and smarter. I think the last stat I heard was it's getting twice as smart every 3.3 months or something. It's expanding at such a rate that it is inevitable that I think we're going to get pulled out of the market, pulled out of our businesses and out competed by our adversaries or other folks in the market who have adopted this and decided to say, you know what, let's just figure this stuff out. And I think it's a leap of faith, but then again, so is making the decision to hire an employee, hiring employee number 2 and 3, and you've got to put some trust out there. And so I think that, being a business owner is, part of it is taking those risks and those calculated risks, but trusting your gut and doing it with kind of a cautious approach and not being reckless. I think in my case, want to have something this foreign to me, a professional help with to make sure that it's done properly. So I'd say that, embrace the unknown, because we're looking down the barrel of it right now, whether we like it or not.
An open-minded, active curiosity. The second you stop pursuing knowledge and pursuing learning is the second you stop growing, right? Taylor, thank you so much for joining us today. Thank you for sharing your story and your insights to the audience. For anyone out there listening who maybe they're approaching a point where they want to sell their business, what would be the best way to find you at Stonebridge?
You can go to our website, stonebridgeba.com, and you can also find me on LinkedIn, Taylor B. Hess.
Thanks again for joining us today on The Growth Shift.
Absolutely. Thank you for having me. Appreciate it, David.
Another powerful conversation on The Growth Shift. If you, like our guests, are ready to turn your expertise into a predictable, scalable growth engine, one that eliminates the grind of prospecting and enhances your high-value relationships, then it's time to connect with Valentix. We are not a marketing agency. We are your strategic growth partner, building intelligent systems that ensure your client acquisition is predictable, not dependent on chance. To see how our AI-powered frameworks can free up your time and fill your calendar with decision makers, visit valentix.io. Thank you for joining us on The Growth Shift. We'll see you next time.